The last couple of days have been absolutely ridiculous. This morning, a good morning to you. Futures are negative 0.2% on the S&P. Chairman Powell reintroduced the risk of moving to a 50 basis point hike. We started to price some of that in. We've taken it all back. We're pricing in 25. How much of that is about the economic data from about an hour ago, and how much of it is about the risk aversion associated with select financial institutions in the past day? We'll have that conversation through the rest of today on Bloomberg TV and radio. There's your opening bell. Switch at the board and get to the bond market. Yields look a little something like this. Look at this. We're down 15 basis points on a 10-year, 375.63. The move on a 2-year, humongous over the last couple of days, from 5.08% all the way back down to 4.68. That is a 40 basis point move in 2 days. Down 20 basis points yesterday, down another 20 basis points this morning. Looking at the FX market, dollar weakness, euro dollar 106.50. We are positive there by 0.6%, and crude negative by about 0.1%. No drama, 75.65. The broader equity market down just 0.2% on the S&P 500. On the Nasdaq down 0.2 also, about 45 seconds into the session. Plenty of reaction to the jobs report from an hour ago. This came from B of A just a moment ago. We think it's a close call. We retain our forecast for a 25 basis point rate hike in March. Of course, that's highly dependent still on what we get on CPI next week, March 14th. It's in the diary, I know. Then on to March 22nd for that Fed decision. One stock to watch for all of you, it's SVB. Shares sinking for a second consecutive session before being halted. The CEO, Greg Becker, urged clients to, quote, stay calm during a call with customers, and Katie Lyons, things have been anything but.
Yeah, definitely not calm. Of course, we are still awaiting that pending news, John, but we did have the reports earlier this morning from CNBC that a capital raise has failed and the bank is in talks for a sale. And I was just checking in with a source close to banking regulators here in Washington who also said it seems fundraising talks have been a massive failure. Hence why you are seeing so much pressure this morning. Of course, the stock hasn't traded for some time now given that halt, but at $39.40 at the last trade, this was a $267 stock on Wednesday. That is how quickly this has snowballed into what seems like a massive bank run. And of course, the concern now this morning, John, is does this bleed beyond just Silicon Valley Bank, which, yes, was heavily exposed to higher risk clients, VCs, tech startups? Or is this a signal of something more systemic, especially among regional banks that are less diversified and very exposed to an environment in which the Fed has aggressively raised rates and that bond portfolio has gone down significantly in value, John?
Kelly Lyons, thank you very much for that. Plenty of research coming through from the South Side. Morgan Stanley's Betsy Graseck said this, weighing in on the contagion risk for SVB. We want to be very clear. We do not believe there is a liquidity crunch facing the banking industry. The headwind for the banking industry is that the cost of liquidity is high and rising. This is a headwind for net interest margins, revenue, and EPS. She went on to write, we do not expect that other banks in our coverage will need to raise capital. That is because we do not expect the same level of deposit outflows at other banks in our coverage. SVB is, of course, still halted pending news. The turmoil, though, pretty clear, spreading to the KBW Banks Index. That index is on course for its worst week since March 2020. Abby, it's been tough.
It has been very tough, ugly in fact, John. And right now we have the regional banking ETF, the KRE, down more than 15% this week, similar to that KBW Bank Index, headed to its worst week since March of 2020 on what is really a flight on capital. And it's interesting because depending on who you talk to, it really seems to bring different views to light. Now, the idea that this is idiosyncratic to SVB, most likely not. It also has to do with the regional banks because, of course, when they were rich on deposits, investing them in securities, and now that you have clients taking out deposits, forced to sell those securities at a discount, and therefore the reason for the capital raise, that is not specific to just SVB. That will go to these other banks, and therefore you have First Republic down 31% today, PacWest also down sharply. But one reason that the big banks today are stabilizing to some degree, John, is they were forced to do this last year through regulatory capital. So this, what we're seeing now for these regional banks, where it was simply they're forced to market when it actually the loss is taken, it was done in advance for the big banks. So the big banks to some degree are a little bit more insulated. Nonetheless, you have all of these banking indexes down sharply, down more than 10% on the week, headed again to the worst week since March of 2020.
It's difficult to know what to do with this, isn't it? And Abby, thank you. About 4 minutes in, we're negative 1/3% on the S&P. On the Nasdaq, we're down 0.4%. It looks like any other day until you look at the bond market. And the 2-year yield's down 20 basis points. On top of the 20 basis point move we saw yesterday with a 2-year at 466 and a 10-year at 375, we're down 15 there. 2 days ago, north of 5% on a 2-year. Now the 2-year close to 450. Closer to 450 than 5%. Figure that one out. PIMCO's Tiffany Wilding has got to figure that one out alongside PGIM's Mike Collins. Deep breath, everyone. Tiffany, let's start with you. You have an hour or so, 60 minutes to go through that payrolls report. Your thoughts, please.
Well, I do think that the banking sector stress is front and center here, and I think it's a good reason because the payroll report is frankly lagging. I mean, that basically tells us what happened last month, and we always know that the labor markets do lag broader fundamentals in the economy. So I think from the Fed's perspective, really the question here is how tight financial conditions are getting as a result of this risk aversion, stemming from the Silicon Valley bank stress. I think the other issue here, obviously, is that even though, I think the liquidity, a potential liquidity crisis in the banking sector is, I still think the probability is that is low. It probably does cause some risk aversion, with bank managers. I mean, are they going to start pulling back on the margin on credit, start tightening credit conditions a bit more, and that's basically doing heavy lifting for the Federal Reserve. So that just means the Fed doesn't have to do as much. So I kind of agree with the markets here in terms of, taking out the probability of 50 basis points.
So Tiffany, we're saying that before we get CPI on the 14th. Are you saying that the bar for CPI to deliver or at least open the door to 50, case closed, is that really, really high?
Well, I mean, obviously, the stress, some of the stresses that we're seeing in markets right now, it's a question of how persistent are they? If we're coming into next week and if people feel more confident this is an isolated case, you don't get the risk aversion, financial conditions aren't tightening as much, then certainly the CPI report, I think, will take more significance. But our own expectation for this report, is that it's kind of core CPI is going to be kind of where it was last month, and we actually do see some reacceleration potential, over the next couple of months as you have used car prices, that look like they're rising again, which has been kind of an idiosyncratic issue in the United States. So I think the bottom line is it's a tough job for the Fed right now. I think, they kind of set out a plan for going 25 basis points to kind of weigh the different risks. They don't want to tighten too much, but they don't want to tighten too little. That still seems like a reasonable plan for me.
Mike Collins, your thoughts on this one, please.
Yeah, Jonathan, a few big takeaways, I think, from the number today, then on the broader market conditions and the Fed. What we're seeing in the numbers today, and we've had some time to dive into it a little bit, you are continuing to see deceleration in almost every metric, from total payroll employment to hours worked, which are down 1.5%. From the peak a few months ago, which is a lot on a big economy. You're seeing wages decelerate. Yeah, you have that mix shift, but we've actually looked at the leisure hospitality wages. They were running, Jonathan, on a 6-month rolling annualized basis around 15%. A year and a half ago, they're down to about 5 now. So steady deceleration. Now, they're not at 3 where they were before the pandemic. And our guess would be that they probably don't get back to 3, that these wages, especially in the leisure hospitality services sector where there's a massive shortage of jobs, continue to be sticky, but generally deceleration there, right? And the Fed, I mean, their MO has always been, they keep moving, especially in an inflationary environment, Jonathan, they keep moving until something breaks, right? And they're so focused on this risk management policy, and there's 2 tails to the risk, right? One is inflation gets too high and they miss controlling it, and the other is something breaks, right? And I would argue the risk of something breaking is now tilting to be a little bit higher than the risk of runaway inflation.
Well, let's pick up on that because that's a really important point, Mike. So, Tiffany, there's 3 parts to this story around the Fed. It's pace, its ultimate destination, and its time spent at destination. Now, if you believe the Fed is destined to break something, can you draw conclusions about how long you think they'll spend at peak?
Well, I mean, I think if we, I don't think the Fed is destined to break something. At least I don't think that's what they want to do, right? They are trying to manage both of those risks, the risk of overdoing it versus underdoing it. And I think they're trying as best they can. But obviously things can happen in a very nonlinear way. When we look historically at payrolls, for example, how they behave after reaching their peak in a cycle, what you tend to see is that payrolls sort of decelerate kind of, nicely, if you will, and that's kind of what we've seen in this cycle. But then eventually they really start to deteriorate, and that's obviously when we go into recession. They don't sort of decline in a nonlinear way and then start to contract. They really just at some point ahead of recessions just plummet. And so it's understanding kind of when exactly that happens, and it's very difficult. So I do think the Fed's trying to manage that risk. The issue here is obviously that we still have very elevated inflation. Now if we do go into a recession, obviously inflationary the inflation will likely come down, wage inflation will come down. So again, I think it's the Fed trying to manage these risks, just with the issue that, things can deteriorate in a very nonlinear way.
Look at this move at the front end of the curve. Mike Collins, we're down 28 basis points on a 2-year. That's 460, sub 460, 459. We were looking at 5.08 just 2 days ago. Mike, I was speaking to Rick about 20 minutes ago. I'm not sure how much of that conversation you caught. Rick Reeder at BlackRock, but he was talking about maybe de-risking a little bit, increasing the cash allocation again. Are you doing the same thing?
Yeah, I did listen to that interview, Jonathan. Thank you. And always like to listen to Rick and Mohammed's viewpoints. But yeah, we have actually come into this environment in a really de-risk manner in our portfolios, and we have really cut the amount of credit risk we're taking. Partly to Rick's point, you're just not getting paid enough to really go deep into the capital structures. I mean, the more levered the companies, the more sensitive they are to higher rates and margin compression, and you're really seeing that start to bite increasingly across the corporate and real estate universes. So stay up in quality. There's a lot of excess yield and spread to be had up in quality. You're not getting paid enough to be down in quality. So that's step one. Keep the dry powder, wait for opportunities to add risk. And I think you're seeing that start to play out here. It's actually been remarkable how resilient, right, the economy's been, how resilient the credit markets have been. I think it's really a testament to the private sector. I mean, throughout this whole pandemic and even today with higher rates, the private sector has adapted, meaning companies and people and businesses have adapted really well, right, to all these conditions. And when rates go up a lot, they kind of de-lever, right? And they look at their balance sheet more closely. They focus on debt reduction, and that's actually a tailwind for credit. So yeah, there's a lot of good credit opportunities out there, but generally you don't want to have a lot of risky credit bait in your portfolio.
Mike, as you know, one man's resiliency is another man's complacency, and some people have said that high yield particularly is looking complacent. South of 400 basis points on a spread, we're now north of that level at 417. When someone tells me I'm not getting paid enough, Mike, I want to know what is enough. How much wider those spreads need to go before you get interested again?
Yeah, so let me put it in yield context just for simplicity, right? So we have a lot of portfolios we manage that are pretty high quality. Some have a duration of 2, some have a duration of 6, and some of these are yielding, in the 6s, close to 7%. Now the high yield market is yielding, in the 8s. So yeah, it looks like it's providing a little bit more, but remember, and we always advise this to our clients, when you buy high yield bonds at 8, you don't keep all of that 8, right? You do lose some of it to defaults. The default rate in the high yield market is at like 1 or 2 right now. It is going to go up to probably 3 or 4. Let's just say it goes to 4, which is about the historical average. That means you lose about half of that to defaults. You get half of that back in the recovery story when you go in front of the bankruptcy judge. So you lose 200 basis points annualized if that default rate averages 4. So that 8-handle yield turns into a 6-handle return, right? Which is very commensurate or comparable to what you're seeing in high quality parts of the market. And to talk about in spread terms, 400, we're back to 420 on the high yield market. I mean, I think they have to be 100 wider. And I think we would be pretty aggressive buyers at those levels because, again, the fundamental quality of the companies in that market are actually pretty good right now.
Well, Mike, let's talk about some spread widening right now. When was the last time you saw a headline like this? SVB 2033 bond spread widens to 1,061 basis points. When did you last see that?
You know, Jonathan, you see it when the Fed hikes policy, tightens policy too much, right? And you see the cracks start to come, and you never know where it's going to be. I mean, I wouldn't have guessed it's the Silicon Valley Bank, and it's always that thing you don't guess is going to be the crack and the problem. And you know, you have this run on the bank risk out there, and there's so much debt out there in the world that investors own, from insurance companies to pension plans to banks to investors, that are underwater, right? That they have unrealized losses, right? And if you have to crystallize that, as is happening at Silicon Valley Bank, it gets to be really painful, right? The Fed has a lot of unrealized losses on their balance sheet, right? And I know Powell was being hammered on that in his testimony this week. I mean, so you do have to be careful about pushing too hard on rates and on tightening policy when you do have these underlying fragilities.
Mike Collins, perfect morning to catch up with you. Tiffany Wilding at PIMCO, just absolutely brilliant as well. To the both of you, thank you for working through some of these big issues. I can tell you, we had this massive move in the bond market, didn't see the corresponding move in the equity market until now, the last 5 minutes or so. We're down about 0.8 on the S&P. On the Nasdaq, we're down more than 1 full percentage point, and we have just got a monster move at the front end of the curve on both sides of the Atlantic. 2-year in America down 25 basis points, 462. Over in Germany, we're down 26 basis points. We've just broke 3%, 299. Kaylee Lyle's back with us for more. Hi, Kaylee.
Yeah, John, talking about the corporate credit market, you just said it. You are seeing serious distress now in SVB bonds. That 2033 bond spread now widening to 1,061 basis points. This feels quite chaotic. And of course, we can't look at the corresponding share move because indeed those shares are still halted in pre-market trading, pending news, which we are still awaiting. But at the last trade, it was down more than 60% in pre-market after a 60% decline yesterday. And of course, we've gotten reporting from other outlets this morning about failure in talks to raise capital. We now understand from CNBC that Silicon Valley Bank's deposit outflows are outpacing the sales process. This is the concern around a bank run here, John, that clients, including those that are with certain venture capital firms like the Founders Fund, are being encouraged to take their money out. And Silicon Valley Bank needs to come up with that liquidity. And of course, this is where it comes back down to those book losses realized now as they look at those treasuries that have gone down in value that they now have to sell at a loss. This is a bank that clearly is in serious financial stress, and some of that stress looks like it's bleeding, at least from a share price perspective, to other areas of the banking sector this morning, John.
And Kelly Lyles, stay close. We'll come back to you a little bit later in the program, hopefully. So we are about 16 minutes into the session. We're down 9/10 on the S&P. On the Nasdaq, we're down by 1.3%. I'll keep returning back to the bond market. Significant moves here. We're down 24 basis points on a 2-year, 463 on a 2-year yield. 45 basis points south of where we were just a couple of days ago. Just absolutely unreal. AMH down in Washington is going to join us now. Anne-Marie, the Treasury Secretary, has been testifying in the last 45 minutes or so. What are you hearing?
Yeah, John, well, so she's set to really just be talking about inflation and the risks of a recession, but potentially this is going to be something that's going to overshadow these questions that she's facing. What we've heard from the White House so far from a key economic advisor to the president, Bharat Ramamurthy, is he's saying that the Treasury Department is looking into this. It is quite really too early for them to see what the situation and exactly how this shakes out. They're calling it highly fluid situation, but they didn't want to say exactly what they could do in terms of this regional bank, but that this is something that they are looking into. And what one part was interesting from Mr. Ramamurthy is that he said, I don't want to say more than I can right now, but just to assure viewers it's something we are on top of. It's highly fluid, and what their concern is that if this would spread and to become more systemic. So don't expect any fireworks yet unless this was to become massively spread across the financial industry and the health of financial assets.
AMH, thank you for that. We're just going to work through some of the price action and bring you the latest headlines. A little bit early this morning, of course. Trading halted in SIVP, news pending. That stock was down by more than 60% earlier this morning in the pre-market, down some 60% in yesterday's session as well. We'll wait for that news. I talked about what was happening in the bond market. The SVB 2033 bond spread widening through 1,000 basis points. That signals, as you all know at home who follows this bond market, that signals real distress. No real signs of distress in the equity market, at least. It's a down day, sure, and it's getting worse. We're down about 1% on the S&P. On the Nasdaq, we're down 1.1%. The moves you're seeing in the bond market, though, let me frame them for you. They're absolutely phenomenal. So you've got Chairman Powell reintroducing the risk, opening the door to a 50 basis point hike, and that 2-year yield breaks 5, goes to 5.1%, just short of 5.08, and then comes all the way back down. Risk aversion yesterday, claims a little bit higher, I know, but the bulk of that move came in the afternoon. Down 20 basis points in yesterday's session, down 20 again today. On Bloomberg TV and radio, I'm pleased to say that joining us now is the US Labour Secretary, Marty Walsh, and he joins us from Washington. Secretary Walsh, what a morning for it. Just amazing moves in this market that we can discuss. Amazing moves on the West Coast with a financial institution. Secretary Walsh, you get to represent the administration this morning. I just wonder what your thoughts on what's been developing in the last 24 hours or so.
Well, certainly on the jobs front, we had a good day, but as you have been reporting for the last, I've heard you for the last 15 minutes, a lot of concern in different areas, and hopefully we can continue to move forward here. I know Secretary Yellen is up at Capitol Hill today testifying. There's lots of concerns about what the future of the stock market is. I know that, but when it comes to jobs, we have a good jobs report and good signs all along.
Are you worried that we're starting to see things break as the Federal Reserve tries to address inflation?
No, because we've been talking about now, and people have been concerned about it for the last year, really. And when you think about what we're doing here, we're seeing jobs being added, we're seeing participation rate going up, we're seeing opportunities for even further participation rate by making some investments, and certainly we're seeing incremental steps in the inflation coming down. So we need to continue to stay focused on that.
Secretary Walsh,
sorry, I froze there for a second because somebody behind me is talking, so it kind of got my head.
Don't worry, it's fine. It's the last interview we get to do together because I know you're heading to the exit too, so I'll give you the time.
I'm going to miss you. I'm going to miss you.
I'm going to miss you too, Secretary Walsh. I've got to fit a couple more questions in there if I can. We heard a little bit earlier this week from the chairman of the Federal Reserve. He took a lot of flack, a lot of heat from some Democratic senators, including Senator Warren, who said that maybe he was pushing this too far. It could lead to people losing their jobs. And he said, would working people be better off if we just walk away from our jobs with inflation of 5%, 6%? Secretary Walsh, how did you feel when you heard that interaction earlier this week? What were you thinking?
Listen, as I said from day one, my focus here is to get as many people back to work as possible and continue to see wages go up, working with business so business is successful. That's what my focus has been for the last 2 years here at the Department of Labor. That's been the President's focus, and we're going to continue on that path.
I know you're heading to the exit. Your replacement facing a little bit of scrutiny right now. You work closely with her. Secretary Walsh, is it a ringing endorsement from your side? Can you give her some words of support?
Absolutely. We've spent the last couple weeks, Deputy Secretary Sewell and myself, meeting with business, meeting with the U.S. Chamber, meeting with the Business Roundtable, meeting with the independent associations. So we're meeting with all those organizations just to talk about what the plan is here at the Department of Labor. We've been connected at the hip for the last 2 years. We work very closely together. Business, I think, has a very good feel for me as Secretary of Labor, and they'll have the same feel for Julie Su when Julie Su gets nominated.
Secretary Walsh, we've got to leave it there. Thank you for your service, sir, and thank you for these monthly interactions. They've been fun. I've enjoyed them, and hopefully we get to catch up soon in your new role.
All right, thank you.
Thank you, sir. Secretary Labour Walsh there. Marty Walsh of the Labour Secretary, of course. I want to come back to this market. Keen to do so for all of you. 22 minutes into the session, equities down 8 or 9/10% on the S&P, and the bond market just a monster move. We're down about 23 basis points on a 2-year. 464. I want to bring Katie Lyons back into the conversation. Katie, still halted, news pending, but we've got some news, haven't we, in the last 20 minutes?
Yeah, indeed we have. Of course, we've had the headline related to SVB's credit, the 2033 maturity, now seeing it widen by 1,061 basis points. We also have gotten reports, John, from other outlets about the sale process, because we understand that fundraising talks, raising capital for a Silicon Valley Bank has failed. They are now looking at a potential sale, and we also understand that now the withdrawal of deposits is outpacing the sale process. So this is a bank that is certainly in crisis. We are still awaiting confirmation of whatever that pending news may be, but at the time of the share halt, pending that news, this was a stock down more than 60% once again today after a 60% decline yesterday. We are now trading south, or we were, of $40 a share. This was a $267 stock on Wednesday. That is how quickly this has unraveled. What is happening here, as we are seeing now realized book losses for one of these banks that, of course, was smaller, of course, exposed to higher risk clients in VCs and tech startups, but there are still a lot of pain bleeding through to other banks as well that may have similar exposure, like First Republic, which is having its worst day since the financial crisis era, down by double digits. It's applying to other regionals as well. There is a lot of concern now about this health of the U.S. financial system, John, in the middle of aggressive Fed rate hikes and a jobs report today that raises the question of how much further those hikes will go.
Kayleigh, in the last 24 hours, the analyst community has been very clear to draw a very, very bold, thick red line, black line, if you will, between what's happening with companies like SVB and what is not happening with the large banks on Wall Street. There is a clear distinction this morning. With Bank of America, let's pick a bank, they're down only 2.8%. Kayleigh, are you seeing that distinction being drawn when you look at the smaller regional lenders as well?
You aren't seeing quite the same distinction. You definitely are seeing steeper losses for also tech-exposed banks like First Republic than maybe some of the other regional banks, but they are facing far more pressure here than their larger bank peers, John, and it does come down to that diversification. The narrative theory here is that those larger banks are not as heavily exposed so acutely to riskier areas. I mean, we have to consider this also as coming in the week of Silvergate, which was heavily exposed to crypto, also very high-risk clients. Now we're talking about startups that also are facing their own funding and liquidity challenges amid a changing macroeconomic environment. It is about the exposure here that is not as diversified, that is so specific, and it is affecting these banks to a larger degree. But John, yes, you're absolutely right. It does seem, at least on the street, that they are really trying to make it clear that there is a distinction here, that this is not about some broad systemic risk in a financial system. It is just those that are exposed to a greater degree of risk in certain pockets of it.
First Republic getting hammered. That stock is down by some 51%. Kayleigh, thank you for that. The line you've heard, the phrase you've heard from Mike Mayo of Wells Fargo and others too, is a lack of funding diversification. I read this quote out earlier. I'll share it with you again. This is what Mike Mayo's got to say on the situation. He said, SIVB is worst case. The core issue at SIVB is a lack of funding diversification. Most SIVB deposits are from VC, has its issues. To us, the larger the bank, the more diversified the funding. That's the line you're going to hear again and again and again. I've heard it all morning, the whole of yesterday as well. Your broader equity market's recovering just a little bit. We're down about 0.75% on the S&P 500. At the moment on the Nasdaq, we're down a little more than 1 full percentage point. We've had a massive move in the bond market this morning. Had a big one yesterday too. We're down another 22 basis points on a 2-year to 4.65. Want to get you the trading diary just briefly. You will hear from the president a little bit later on, 10:45 Eastern. He'll meet the EU president a little bit later on as well. Pushing ahead to next week, Tuesday. It is the only thing that matters. It's CPI day in America. Then you get some retail sales as well. From New York City, that does it for me. If you can enjoy the long weekend, or rather the next couple of days, this was the countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, March 10th. Here are the top market stories we're following for you at this hour. SVB's meltdown. Silicon Valley financial craters. Despite attempts to prevent a bank run, some big venture capitalists tell startups to withdraw their money. And that leads to contagion effect. Regional banks sinking, halting for volatility. SVB's 2033 bonds blow out, signaling distress. And equals Fed's financial stability problem. Swaps are now pricing a 25 basis point cut from the Fed this year. Two-year yield sinks 48 basis points in 2 days. The German bund yields see the biggest slide since 2008. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, this is the screen I have up. The KRE index, and you go to MOV, and it shows you all the big movers in the regional bank index, and these moves are unbelievable.
The screens are lit up, as you say. There is clearly quite a lot of consternation in financial markets today. Is that consternation rational, is my question. You are looking at, as you say, a huge move in terms of rate pricing. It's near 50 basis points over 2 days for the US 2-year. This over a fairly mixed payroll report. Yes, there was something for everybody in that report, and a potential failure of a relatively small bank. The US economy is huge. It should be able to handle this kind of incidents. We have the regulatory framework to handle this kind of stuff. So why is the market so offside? Why is the market kind of acting in the way that it is right now? Why the consternation?
Well, I have a couple questions on that. One, are we looking at a lot of individuals trading who weren't around in 08? Two, I have to think there's a ton of positioning washout right now. Like maybe the move was in some way justified. Say you want to be buying some 2 years because you're feeling a little uneasy, and then boom, you hit some levels, and then there's a huge surge of buying, and that same maybe goes for some of the regional. I mean, I just can't imagine what people's books are going to look like today by the end of the day.
Well, I think, and remember, we've got the 14th. The CPI number is coming up as well. You get a hot CPI print. Does the market ignore that as well? I don't know. It seems that there seems to be some symmetry issues here in terms of the scale of some of the problems. Yes, the payroll report had some issues that maybe showed that the labour market is slowing. But as somebody pointed out, from a super hot level, just a hot level. That's kind of where we are. And then you've got this whole issue, Alex, of where rates are ultimately going to go. And is SVB just a kind of canary in the coal mine? This is a pre-shock.
Exactly.
Central banks are raising rates. They're raising rates quite aggressively, both here and over in the United States. And a lot of banks have got a mark-to-market issue, potentially, if they're forced to sell assets.
Yep, exactly. And this is where I think it goes to the heart of the issue for what SVB is. If you have some of your assets in safe things like treasuries, what happens if the treasuries are no longer safe because of massive volatility? Like, where are you supposed to then put your money? I think that is going to be a really interesting question going forward, and I cannot imagine that regulators are not going to be looking at this at some point and taking a bigger crack at the regionals.
Yep. I have to say, having worked my way through the European debt crisis, this all feels eerily familiar. The doom loop that we talked about then feels like it could be something that we want to maybe revisit. Anyway, this takes us to our question of the day. Are rate hikes creating financial instability? Let's try and answer that question. Mike McKee and Ed Ludlow join us now to discuss. Ed, I want to start with you. There's consternation on Wall Street. Just walk me through what is happening in Silicon Valley right now in terms of what happens next. How much fear is there on the streets of Silicon Valley?
Yeah, look, the longer term story is that the higher rates situation has redrawn the map on valuations, right? And what we see from a sort of mechanics standpoint is down rounds, but basically founders and startups being able to raise money at much less favorable terms. The near-term story is that they were pulling deposits from Silicon Valley Bank, and the reason they were doing is that they didn't need their cash in the bank. They're facing a really serious cash burn situation right now, which means they needed the cash at hand. A big part of that as it relates to jobs is basically the need to go out and hire when talent was on the market, or they just face incredibly tough times where their services and businesses are not as in demand as they were in the pandemic era, or they're just simply not able to raise more capital to give them that kind of surety of liquidity over a long time horizon.
Mike, and this is where I feel like this story hits your world, which is if they have most of their assets and securities available for sale and securities held to maturity, and a lot of that winds up meaning treasuries, did the Fed create instability by having this kind of volatility in the treasury market that then leads to things like this?
Well, it's collateral damage. I mean,
this is a big collateral damage, no?
Yes and no. This is different from 2008, and it's different from the European banking crisis. This may be very limited, but SVB, because of its position, gets a lot of publicity. There's a difference between banks that take surge funding, like when you're getting VC funding and you get a big check and you stick it in the account, and if that gets pulled, you're in big trouble. And then a lot of the small to medium-sized banks are in the relationship business. Basically, what they're doing is helping small businesses out that aren't going anywhere, that aren't seeing major changes, and they're also dealing with mom and pop who deposit their money there and aren't going to be moving the money out very quickly. The difference now is that in 2008, every bank, it seemed, had a lot of bad real estate on the books, but not every bank has the same kind of deposit and business model. And so it's something the Fed has been keeping an eye on. You notice everybody, all the analysts are saying that the big banks are okay. This has been in the stress test. The smaller banks don't get stress tested in the same way, and they perhaps need to tighten up. But it's not going to be, it doesn't look like, I never want to say never, but it doesn't look like this is any kind of systemic problem.
It isn't until it is, Mike. That was the lesson learned from 2008. We thought at that point that we understood the connections in the economy. We didn't. And I'm wondering whether or not there is that risk here again. You have the smaller banks, you have the banks that are exposed to tech, the Ed's been covering, and then you have the non-financial institutions as well. Risk has been moved out of the major banks post-2008, post the GFC. Where is it now?
Well, that's a very good question, and it's a very good point, especially about the non-banks. And the problem for the Fed is they can't do anything about that. There's really nobody who can do anything about that unless some of the non-bank financials get into trouble, and that spills over into the banking system. As I mentioned, the Fed has done a lot of stress testing on the larger banks. They know what's in there. They they've modeled this idea of your collateral falling in value. So they're not as concerned right now about what's in the banking system, but we could certainly see an issue outside the banking system.
Right.
And when I said I never want to say never, I'm agreeing with your point that it's not a problem until it is.
Yeah, as we all learned like 15 years ago. And definitely with the shadow banks, that's such a good point. Hey, Ed, it might not be then systemic right now for the banking industry, but is it systemic for the VC funding tech industry?
Yeah, look, what I'm hearing in every phone conversation I'm having, every conversation in the last 24 hours is that what is important is that startups, technology companies need access to banking. They need access to cash flow in order to run their businesses. We have reported, according to sources, big names like Founders Fund, Y Combinator, advising their portfolio companies to pull cash from or deposits from Silicon Valley Bank and go elsewhere for that reason, to make sure that they can have access to working capital and other banking services that they need. That's not a universal view. There are many venture capitalists saying, hold on, Silicon Valley Bank or SVB Financial Group are literally a pillar of the spiritual home of technology, which is Silicon Valley. We are here today because of the work that they did. They have for a very long time been a competent bank, and I make that point because lots of VCs are telling me that actually in some cases they're telling their portfolio companies to stay put. There is a hope that a white knight comes in, which is a conversation coming up on calls between VCs and their companies a lot, is what I'm hearing. But it's worrying, right? One final thing, they keep pointing out there's a difference between solvency and liquidity crisis. crisis. I don't quite understand that distinction, but that is a consideration for VCs as well as they look at the health of SVB.
Right, but it's, as we were saying before, it's not solvency issue until it's a solvency issue, right? You have to wait and see how far it perpetuates. All right, guys, we're going to talk about this all morning. Mike, I really appreciate it. Thank you so much. So coming up more on our question of the day, are rate hikes creating financial instability? We're going to put the question to Anna Rathburn, CBIZ Investment Advisory Services CIO next. This is Bloomberg.
A lot of concern in different areas, and hopefully we can continue to move forward here. I know Secretary Yellen is up at Capitol Hill today testifying. There's lots of concerns about what the future of the stock market is. I know that, but when it comes to jobs, we have a good jobs report and good signs all along.
That was U.S. Labor Secretary Marty Walsh last hour on Bloomberg Television. And speaking of Janet Yellen testifying Capitol Hill, saying that the Treasury is monitoring, quote, a few banks amid the issues over at SVB. So let's get to the question of the day again. Are rate hikes creating the financial instability that we're seeing? Let's get to Anna Rathburn, CBIZ Investment Advisory Services CIO. Anna, that's the question. Is this because of the Fed?
Well, certainly the Fed wants to create tight financial conditions, and I think this is what you're seeing today is a contagion of that. And fortunately for large U.S. banks, they're relatively healthy. 08-09 has changed the landscape of large banks and their financial health, so I don't think the worry should be a contagion of run on the banks, but certainly investors are worried about such a contagion scenario.
Where do you think that could show up? Could it be coming out of what's happening in commercial real estate right now? That looks like a potential area of risk at the moment. Look at what's happening with European banks. The BTPs, BTP 10s, they've accelerated to the upside as the ECB's been raising rates. And Italian banks hold an awful lot of those BTPs. At some point, maybe there's a mark-to-market issue. Where are you looking? Where would you be thinking, Anna, about where risk could come from?
Well, so one of the things that we have been saying is, especially when people were saying no recession or shallow recession, is that, well, hold on. The Fed has been raising rates at a very
fast pace. And this has to end up somewhere, show up somewhere in the economy, in the banking system, in the financial system. And I think this is the first of what we're seeing. I was expecting it to be a little bit later because it does take time for it to move through. But because the rate hikes were so rapid, I think we're seeing it in the banking system. Now, SVB is relatively small, and as I said earlier, larger banks are better capitalized. So I think at this time, it's a little too early to worry about contagion and where it might show up, but certainly leverage, anybody who's leveraged, anyone who has not enough liquidity, balance sheet is a little bit shaky, those are the areas where we really need to be concerned about.
Anna, where does this leave the shadow banking system right now?
The shadow banking system, do you mean like lending by, you mean USD, US dollar market?
No, I mean like the non-banking lending system. And then you also look at, say, private equity in addition to that, that's not regulated in the same kind of way that a lot of companies and individuals had to go to get money because they weren't allowed to go to big banks. I mean, there's a lot of money that migrated to that.
Yeah. Yes. So, you know, in the private equity and private credit, the collateral is different, right? They're not collateralizing based on a portfolio of treasuries that we know is not as safe as we thought or is more volatile. They're collateralizing based on cash flows of businesses and health of businesses. And that underwriting process is completely different. So I also don't see a contagion of the banking system going into the private credit sector of the economy.
Anna, does a near 50 basis point move in the US 2-year make sense to you over the last couple of days?
It does not. I do think that the market is overreacting, and some of this, of course, is due to the labor market data that came out today. My interpretation of that is it's a strong data, strong jobs report with some weak streaks in it. It's not anything to be really excited about in terms of will the Fed, start cutting, and I think the markets are starting to price that in. The Chairman Powell told us today he's looking at the totality of the data. This is just part, not the whole. Yeah. And if the Fed is paying attention to anything, if they're thinking about being less hawkish, it's really about the banking developments today and yesterday, not necessarily the labor market report.
I know. It's like I couldn't believe I had to take the labor market data out of my intro to the show. It's like unheard of. Anna, before we let you go, this is creating a lot of distortions in the market. What can you take advantage of to buy right now today?
Okay, so we don't pick stocks, so let me tell you a little bit about how we're positioned. Defensive has been the theme, even through the equity run-up year to date. We have been saying that we do see a recession on the horizon, and this is the type of event we were worried about. And if you look at the forward PE ratio on the S&P 500 index, it's a little bit too high if you're expecting a recession. And from a relative value standpoint, I know Treasury's been very volatile, but earnings yield versus Treasury yield, which is relatively risk-free, it's not even a competition. So I think from a asset allocation standpoint, quality is the way to go. If the banking crisis, or I shouldn't call it crisis yet, I don't want there to be a contagion, but certainly a warning sign is telling us anything. Liquidity is the name of the day.
Yep. This feels eerily familiar of past crises, let's use that word, in the past that we have been through. Anna, thank you very much indeed. Anna Rappen, CBIZ Investment Advisory Services Chief Investment Officer. Still ahead, Silicon Valley waking up to the SVB fallout. We're going to get reaction next, more reaction next. This is Bloomberg.
Great questions. From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Lisa Mateo. Bitcoin is having its worst week since November. An equity sell-off, fear of over higher interest rates, and U.S. crackdown on crypto combined to hurt investor sentiment. Bitcoin fell below $20,000 today for the first time since January. The U.S. is trying to close a loophole in restrictions imposed on Chinese server maker Inspur Group. That loophole allows American companies such as Intel free to keep supplying Inspur's affiliates. This month, the U.S. added Inspur and dozens of its peers to an export blacklist. And shares of Gap are lower after posting quarterly sales that missed estimates. It's an indication the retailer struggled to attract shoppers during the holiday season despite deep discounts. Gap has been looking for a new CEO since July when Sonia Singhal was ousted. And that's your Bloomberg Business Flash. Alex.
All right, thanks so much. Really appreciate it, Lisa. So it's 21 minutes past 7 on the West Coast. Want to get to the startup, but we're going to cover all the top tech stories from the Bay Area and beyond. The Silicon Valley starts its morning, and there's only one story today. Joining us now, co-host of Bloomberg Technology, Caroline Hyde. All right, Caroline, what's the word? What's the word from Silicon Valley and what's happening with SVB?
Mourning, sadness, fear, all three combined. It was yesterday while I was sat on your seat doing the show that those headlines started to trickle in. Founders Fund saying that they were advising their portfolio companies to rethink their deposits over at SVB. Then came Y Combinator. At that point, we saw the after-hours shock ripple through. But I think what we're hearing, whether it's Telegram, whether it's Signal, whether it's Discord, whether it's WhatsApp, whatever flavor of messaging app that you're using, they are alight at the moment amid those companies, the portfolio companies that talk to each other, the founders, the CEOs, the CFOs, and also their own general partners, the companies that have funded them, the VCs, all trying to garner whether they should be diversifying out of Silicon Valley Bank, and with a heavy heart so doing. We had not one, not two, but three VC or founders on the show, all responding in the moment. John Wu over at Ava Labs was saying he was reconsidering this was looking like what he called a bank run. You then had another key founder from Forethought saying while he's excited about his AI announcement, he's having to be worried about his banking partner. And then we had Morgan Bella, who is over at NFX. She's a VC thinking about stablecoins, but in this moment was telling us what she was advising her portfolio company. She said it felt like the sky was falling. Just take a listen.
The biggest question that we're asking is how will this impact our portfolio companies from operating their businesses in the day-to-day? And I don't think we're worried about everything vanishing, overnight, but we are worried about our companies being able to access working capital that they need to run their businesses today, tomorrow, and over the next few months. So it's unclear exactly what the objective sign is that we are looking for, but that's kind of the question we're looking to answer.
So ultimately, if you've got a portfolio company with more than 250,000 in SVB, you're probably being asked to diversify that out.
So Caroline, if SVB is terminal, we don't know yet, could get bought, we don't know what's going to happen here, but let's say it goes away, where does the liquidity come from? Who do they turn to?
I think this is exactly the issue that the crypto market has been trying to confront with Silvergate, and now it turns to, well, startups more generally. Ultimately, this is an infrastructure issue for the overall West Coast. I think they feel that they've got enough banking partners. Ultimately, this is about companies at the moment burning through cash, needing to take out their deposits, and VCs unwilling to write as many checks as they've been doing so in the past. But you're right, they're going to have to turn their attention. First Republic, as we're seeing, the shares falling on that particular company. Many of the founders I spoke to yesterday had First Republic relationships rather than SVB, were feeling rather smug, and now I think they're probably also rethinking about how they want exposure across the banking system and whether or not you want to put too many eggs in a bank that was basically focused on the startup and innovation sector, which at the moment is going through a torrid time, Guy.
Who's sticking by it?
Well, there are actually founders and VC names coming out saying, look, they are a great partner. We heard from Morgan Bella saying they've been there for us. We want to support them. Mark Suster, big name in VC, Upfront Ventures. He's saying, look, we believe the CEO when he says that this isn't any sort of fatal issue overall. So there are a lot of names coming out and trying to say, G Squared is also another VC that's saying, look, stick by them. They are a good banking partner. But ultimately, if they get bought by someone else, how much are those strong in those relationships? And if you're a founder and you're literally your baby, your child, you are going to want to make sure that you diversified, that you're not putting all of your money into one particular financial. And ultimately, that's good due diligence. If you're a founder, if you're a CFO, you should be thinking about diversifying your treasury.
Yeah, probably some painful lessons are going to be learned on that front, though. Caroline, I can't think of a better time to have a tech show on air. Really looking forward to yours. It's going to be fantastic. You're going to get all of the SVB fallout, the special edition of Bloomberg Technology today at 5 p.m. and beginning Monday, this is what I'm really talking about, Bloomberg Technology has a new time, a new home with Caroline and Ed, 12 p.m. Eastern, noon. It's going to be great. Coming up, our continuing conversation on what the jobs data means for the Fed. Seems to be a bit overshadowed today by the SVB story. We are going to get another voice into the mix on this story. Looking forward to this. This is Bloomberg.
We're about an hour into the U.S. trading session. S&P is only down 0.7%. You look under the hood, though, it's still all the action and volatility in the bond market and the regionals that we want to track here. Abigail's tracking those moves for us. Abby?
Yeah, and here's this plunge for the regional banking index on the week, down about 15%. At the lows, this KRE, this equity ETF, it had been down 20% at that point, the worst week since 2008. That's the degree of the sell-off that we've seen in these regional banks led by SVB Financial Group. Right now, down about 15%. And the interesting point to be made here, of course, is that there's a little bit of a feel of a run on capital, run on the banks. The idea that these banks, these regional banks and the big banks, in fact, were during the pandemic flush with deposits put into securities. Now, SVB's clients, of course, being tech and VC, having a little bit of a tougher time starting to withdraw those securities, so taking it out and that run on capital to some degree. But there's an important distinction if we flip up the boards. There's an important distinction with the big banks, and that is the fact that the big banks had to mark these losses down last year. So as a result, and this is actually the S&P 500, a broader look with the 2-year yield. So the S&P 500 down about 0.7%, that 2-year yield coming in 25 basis points. And I would argue that has less to do with systemic risk and bond traders once again getting it wrong in terms of their expectations around the Fed. Now, if we do go to the next board, we're going to see this divergence between the regional banks and the big banks, which is basically this. So we have the regional banks down sharply on the day. We have JP Morgan down up 1.2%. Wells Fargo moments ago had been higher. Again, these banks last year were already forced through regulatory capital to mark down those losses. These regional banks, they do it now as the losses are realized. So the fear is that it's not just idiosyncratic to Silicon Valley Bank, that the other banks, they also have this, even if their clients aren't necessarily tech. But so you can see First Republic and PacWest down sharply. But those losses paired in a big way. These banks not so long ago had been down 50%. So a lot of turmoil making its way through the markets. Let's, of course, connect this to the S&P 500 chart, which is breaking down below its 200-day moving average and this trend line. I would argue, though, Guy, if you take a look at a different version of this chart, that this could actually just be strengthening this uptrend. It doesn't show well here, but I would say let's wait till the market closes and also next week. I think that when cooler heads prevail, we might see some of this work its way through.
Maybe the glass is half full. Abigail, thank you very much indeed. Let's carry on the conversation, get back to our question of the day. Are rate hikes creating financial instability? Verena Rucci, T. Rowe Price, US economist, joining us now to try and answer that question. If you look, Verena, to what is happening today, do you think if you're sitting in Silicon Valley this morning, not just at the bank but elsewhere, that you can blame your troubles on the fact that the Fed has just delivered its most aggressive rate hiking cycle since the 1970s? Is that to blame?
Well, I think this is a very interesting question. And when we're looking at the broader macroeconomic picture here in the U.S., we need to take into account the fact that over the last 12 months, interest rates have increased a lot. But not only that, we've been pulling away liquidity from the financial market by reducing the Fed balance sheet. And then the other piece of the puzzle is that this has been happening at a global scale. It's not just the Fed that has been increasing interest rates and sort of shrinking its balance sheet. So I think right now we're starting to feel finally those long and variable lags with which monetary policy works. And the first sign of that is I think that what we're seeing with the Silicon Valley Bank here, lots of businesses and banks, we're going to find out this year, are not able to operate at this higher interest rate.
Lorena, if this is the start of, is this the start of a liquidation feedback loop? And will there then be a Fed put because of it? We're already seeing the swaps market now priced back in a cut by the end of this year.
So I think this feels a little bit like the climate that we were experiencing back in October of last year where during the annual IMF World Bank meetings here in Washington, D.C., everybody was worried about global financial stability risks. This is what the Fed and the markets need to figure out over the next few weeks. Is this going to spill over to the broader financial system? Now, regulators here in the U.S. have spent the last decade and a half making sure systemically important
and banks have enough capital in their balance sheets for days like this and for this type of events. So my prior is that this should be contained within the smaller regional banking system and shouldn't spill over more broadly. But I think this is the key question that we need to figure out before the Fed decides at the next meeting whether they really want to go ahead with a 50 basis point hike.
Okay, let's fold the payroll report into that then. If what was happening with Silicon Valley Bank was not happening right now, would that payroll report have confirmed to the market that the Fed is likely to deliver those 50 basis points at its next meeting?
So again, of course, what's happening with SVB does muddy the water a little bit, but the payroll report was strong, and it confirmed that even after the January payroll report, there is momentum in the U.S. labor market to still produce jobs at above trend growth. So we saw some payback, of course, in healthcare. The tech sector remains an ongoing issue with employment declines for 3 consecutive months there, but the services sector, hotels, retail, hospitality, they are pretty strong, and I think they underline my expectation of ongoing strong demand in services spending from the consumer side.
So if that's the case, are you looking for 50 or 25 in March then? And yeah, we'll start there.
Yes, I think just like the Fed, I am waiting for the CPI report. I think based on macroeconomic data alone, core CPI reading of 0.4 or 0.5, plus the payroll report that we saw today, I think would justify the Fed increasing the pace of hikes. But of course, I don't think they can make that decision in isolation to what's happening in financial markets today and financial stability risks.
Irina, if they hike by 50 at the next meeting, is the likelihood that they go 50 at the next meeting? How does that change the trajectory of how quickly we get to the terminal rate and what that terminal rate is?
So here's the thing. We have a Fed that hasn't been too shy or too concerned to flip-flop a little bit from one meeting to the other. We stepped down the pace of hikes to 25 basis points last month, and now we're considering 50 again. So that doesn't give me a lot of faith to what they're going to do at the May meeting. But based on like smooth monetary policy, risk management, if the bar is met to increasing the pace of hikes to 50 basis points in March, I do think that that would indicate that there's going to be at least a couple of meetings where we increase interest rates at this faster pace, and that gets us closer to that 6% terminal rate that much faster.
Okay, so walk me then just forward just to Monday for a moment. The more dovish part of the labor report was the unemployment rate rising and also wage growth slowing. Yes, I understand it's still relatively elevated, but it is slowing on a month-on-month basis. So what are you looking at from core X services, X housing on Monday that's going to help you get real direction from the Fed then for March and then May?
So that's a very important question. So we need that component of inflation to really slow down significantly. But the other thing is we need that component of inflation to slow down on a sustained basis, not just for 1 month. And that's, I think, if you just look at that in isolation, the bar there hasn't been met, especially if you couple that with a strength in employment growth in services components outside of, in hotels and hospitality.
Irina, does a near 50 basis point move in the US 2-year over the last 2 days make sense to you?
Yeah, this is, you know what? When the reaction function of the Federal Reserve, it's unclear and it keeps changing, I think you end up with outcomes like we've seen this week. It seemed premature to slow down the pace of hiking at the February meeting based on what we knew about the economy and how much more progress we needed on inflation. But then it became clear that once they stepped down the pace of hiking, that they would stay there. That was the communication. And suddenly this week, we learned that they're looking at the data in a different light. So I think you end up where we were this week if that communication strategy keeps moving around.
So to that point, last question, if we get to a 6% terminal rate, what happens with the 2-year? What should it be at?
Well, the 2-year is always, it should be higher, but it's also going to be worried about a policy mistake and how soon the Fed may need to take away that tightening in monetary policy if the financial stability risks spread to the broader economy and if that unemployment rate increases significantly in the next 6 to 12 months.
All right, Blarina, thank you so much. We really appreciate it. What a great day to be talking to you, Blarina Urici, T. Rowe Price, U.S. economist. Thank you so much. So coming up, is SVB Financial Group's troubles isolated or systemic? We're going to dig much deeper into the regional banking story. You're looking at First Republic down about 18%, PacWest down 24%, what they're exposed to, what their balance sheet looks like. We'll break that all down with Bloomberg Intelligence Senior Banking Analyst Herman Cham. This is Bloomberg. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China's Xi Jinping has cemented his effort to consolidate power. Lawmakers unanimously voted to give Xi a third 5-year term as president. That demonstrated his unrivaled grip over the Communist Party. Xi has effectively discarded the collective leadership approach that China has used since its reform experiment began in the late 1970s.
Donald Trump is likely to face criminal charges in New York. According to the New York Times, the former president was told he could appear before a grand jury next week if he wants to testify. That's said to be a sign that an indictment could follow soon. The case has to do with the former president's role in paying hush money to a porn star. President Biden and European Commission leader Ursula von der Leyen are trying to avoid a fight over trade. They meet today at the White House. The U.S. and Europe have clashed over the president's clean technology law. The two leaders are expected to agree to let European firms benefit from some of the battery subsidies offered only to U.S. producers. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Guy.
Lisa, thank you very much indeed. So there are a whole bunch of financial ETFs out there that are really worth paying attention to, and they were certainly popping around pre-market when I was checking them first thing this morning. There are some leveraged ones out there, yes, DPSD, I'm looking at you, but basically the funds that I've been focusing on today are the KBE, which is kind of the banking one, and then you've got the KRE, which is the regional banking ETF. And this chart really just highlights the difference that we're seeing right now as we see this the Silicon Valley Bank story explode onto our screens. Banks are down. Banks broadly are lower, Alex, but it's the regional banks, and you can see the spread here, how big it is, that are really taking the hit here on the back of what is happening. Everybody's trying to do the maths and figure out what their balance sheets look like, what the risk on those balance sheets look like, particularly given the rate hiking cycle that we have seen.
Yeah, I'm looking at that blue line, which is the XLF U.S. equity, and the biggest holdings there are Berkshire Hathaway, JP Morgan, and Bank of America and Wells. So not the banks that are going to have be exposed or have these kind of systemic problems. Also, if you take a look at the other one, the regional bank ones, it's all the guys. It's Western Alliance, it's East West Bancorp, it's Fifth Third Bancorp, so it's all those regionals. And as you were mentioning, that spread just keeps widening. So let's get more on the SVB fallout and the rest of that regional banking industry. Here's what some Bloomberg guests had to say about that risk of contagion.
This could be a tame example. There are many other banks out there. So it's very rational for investors to be asking, is there contagion in train right now?
I really don't believe that that's likely.
I don't think it's cause for contagion, but people are going to be scared about it.
I don't think there's a greater risk to the financial sector. I do think some of the banks that tend to cater to the riskier sectors in the market, the venture capital, the cryptocurrency, those types of banks do have risk.
This is a classic bank run. And when the bank run starts, you don't want to be the last guy there and wondering what happened.
The reason I'm urging calm is I do not believe that anybody will lose money if they leave money in SVB. Why? Because in the United States, it's been since the 1980s, since there has been an insolvency in a bank in which people lost deposit monies.
Small banks, I think, is where the issue lies the most, while large banks have a bit safer and more liquid balance sheets than they did in 2007.
If they can raise the capital, it's not an existential issue.
Joining us, Herman Chan, U.S. Regional Banks Analyst at Bloomberg Intelligence, who's been deep in this for a very long time. Herman, what other bank has characteristics like SVB that we actually need to be concerned about?
Right. So SVB is a bit of a unique institution. It caters largely to the Silicon Valley community. So we're talking about startups, we're talking about venture capital firms, and their bread and butter, everything that they do is catered on to these companies. So it's a different animal. There are other banks that have the businesses that overlap, but none with the singular focus with SVB. So we're talking about banks that have some sliver of exposure to the venture capital and startup community, including PacWest, First Republic, Western Alliance, Signature, but those banks, it's a small portion of their overall business.
Herman, what this does, though, is flag maybe a wider risk, and that is that rates have gone up very quickly. We're going to see competition, therefore, for deposits. The banks are going to have to pay out more on that front, but also that there's a whole load of assets sitting on their balance sheet that if marked to market now would be a problem, would generate losses. Is that, you think, the wider question that is now being raised within markets?
Correct. That's a broader question that is the focus in the current rate cycle today. A lot of the banks within our coverage and the largest banks bought a very heavy amount of investment securities during the pandemic period when deposits were rising because of stimulus and the Fed's quantitative easing measures, and the banks needed to park that liquidity into something that would generate income because lending was a bit soft. So the banks across the industry added securities onto their portfolio when rates were zero, and now with rates elevated, the value of those securities has come down dramatically, and that is what in effect spooking the markets too.
So to that point, if you look at different banks and their types of assets to deposit liabilities, which other banks have a lot of securities that are available for sale or held to maturity versus, say, cash and short-term assets?
Right. So SVB definitely sticks out.
Number one.
Number one because of that, due to the fact that they cater to the startup community that we talked about earlier, and the startup community saw exploding valuations during the pandemic period, IPO activity, venture capital, robust deployment activity, and that flowed into SVB, and SVB had less lending opportunities, so grew their securities portfolio exponentially. So they stand out as
what other banks do also have that?
The other banks have grown their investment securities, but not to the same extent, which is another reason why we think the SVB issue is a bit of an outlier and contagion risk is low.
Herman, can we park some of the blame for this at the rate at which the Fed has hiked rates? Has the Fed in some way created this problem by the speed with which it has moved?
Correct. The whipsaw in interest rates is the issue, and the issue is that SVB is a bit suffering from the success that they garnered during the pandemic period. So it was rational at the time to invest in securities, but now with rates where they are today, they're suffering from an unrealized loss position.
So what kind of regulation now is going to have to come down to the regionals to fix this?
Yeah, that's a good question. It's a bit esoteric, but there is something called OCI that can hit the regional's book value. It already hits the largest banks, so JP Morgan and the like already have this unrealized loss position on their investment portfolios hitting their book values, whereas their capital ratios, whereas the regional banks do not. So the regulators may need to tweak those rules given what's going on in the markets today.
If we were to see a wind down, Herman, how does the process work? We heard just a moment ago from one of the guests that we've been speaking to saying, you're not going to lose money, you can leave your money in there. How big a risk is that? How would the wind down process work here, and what could be protected and what couldn't be protected?
Yeah, so the best case scenario for SVB right now is that they somehow garner the capital raise that they're looking for, and they muddle through with the issues that they're facing today. If the event that doesn't happen, then most likely the Fed steps in and pushes for a sale with a larger institution, and depositors would not be at risk.
Who would buy it? Like, it's an unfair question to you, but like, what kind of bank would be able to buy it and want it?
Well, SVB still is a very valued franchise because they are unique. Silicon Valley and the startup community has been a growth driver for the U.S. economy for decades, and that's very appealing for regional banks, larger banks. So we could see a number of banks, even Canadian banks, come in and be interested in opportunity.
Herman, thank you so much for stopping by. Thank you for updating us and giving us some background on what is happening here. Fantastic coverage of this from Bloomberg Intelligence. Herman Chan of Bloomberg Intelligence joining us on the SVB story. This is Bloomberg. So we are nearly at the end of the day here in Europe, and wow, what a session it has been this Friday. We thought we were going to be talking about the payrolls, but not so much. Stock 600 down by 1.76%, and that is being driven by, yes, you guessed it, the banking sector. European banks are being pummeled today, down by 4.5%. Now, there's a couple of things you need to know here. The first one is that they've come a long way very quickly. Take a look at the one-year chart and you'll see that it basically goes up, 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 and there's a little tick lower, which is this. The other thing is that when people start talking about mark-to-market risk and European banks in the same sentence, it generally sends a shiver down people's spines fairly quickly. We all remember the doom loop. We all remember the close connection between the government market, the sovereign market here in Europe, and the banking sector. That in many ways still exists and has not gone away. But we are getting significant volatility as well in the German two-year, which takes us back again to 2008. This is the biggest move in the German two-year to the downside that we've seen since 2008. Hairs standing up on the back of the neck. Okay, so we're going to talk about this a lot more in the next hour. Amaleti is going to be joining us from Allspring Global Investments. She is the head of active equity and the chief diversity officer over there. She's going to be joining us. We've got a pretty good lineup over the next hour, trying to come at this from a European angle, trying to understand where the risk lies in Europe, and is this something that the ECB needs to be thinking about as well? We talked a lot about the Fed and its aggressive rate hiking cycle. The ECB is not done, could go 50 again soon. Is that going to be a cause of financial instability? We will discuss that next. This is Bloomberg.
At that all day yesterday.
Friday, the 10th of March. Wow, what a session. European equities are being pummeled. The epicenter of the action is firmly in the banking sector. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So I'm going to forget the bond market for just a moment, just park that to one side and just talk a little bit about what is happening in the equity environment here in Europe. European equities 452, we're down by 1.5% right now. We're still pricing what happened yesterday afternoon over in the United States and continues to happen today. The banking sector is at the epicenter of the action. We are down by 4.29%. I'm going to show you the longer term chart in a moment. It is important, it is worth paying attention to. Credit Suisse, fresh records on the downside, further pain there. Take a look at what is happening on the credit default swaps. Pay attention again. History just kind of makes the hairs on the back of your neck stand up a little bit. Let's take a little look at that chart because I think you do need to see this chart because of the context. European banks have come a really long way really quickly and that is something that I think you all need to be aware of when you watch what is happening here. The tick lower, that's the tick lower. That's where we are right now. And as you can see, since November, we have absolutely rocketed higher for the European banking sector. On a one-year basis, it's up by 23, nearly 24%. So yes, it's a chunky move to the downside that we are seeing today, but it only unwinds a fraction of the extraordinary rally, Alex, that we've seen over the last few months.
Yeah, here in the U.S., I got to be honest, Guy, you look at the headline, you look at the main indices, and you're like, nah, okay, it's a pretty boring day. And that is so not the case. So the S&P is actually almost flat. SVB Financial is unchanged. Yes, we've had massive halts of volatility over the last 48 hours. A lot of the drama now being reflected in, say, PacWest or First Republic. First Republic is the worst performing stock on the S&P, and a lot of halting for volatility. The KBW Bank Index just down 1.5%, in part because you have JP Morgan, Wells, all the big guys kind of holding up the overall index as the regionals still get hit. Although even that, at one point First Republic was down 50% today. It's now pared those losses quite significantly. Now the real drama to me is in the bond market. The 2-year yield is down 25 basis points, which feels like nothing compared to what it was down over the last 2 days. We're down 50 basis points in 2 days. That is an unbelievable move. And you have to ask yourself, why? Who's actually buying? Is this a positioning story? Is this purely a worried about contagion story? And that's really rippling across to Europe. I mean, these are, for those of us who were around 15 years ago, this is a really big chunky move that is a lot of head scratchers.
Absolutely. Can we just drop the 15 years ago because that's making me feel old for the day? Thank you very much.
You're welcome.
We'll just park that as well. So the question of the day really relates to the banking sector, and it comes back to this market issue. Rates are going up really quickly, and the rate of change here is important. So are the rate hikes now creating financial instability? And is what we're seeing in Silicon Valley a pre-shock that the rest of the financial sector really needs to pay attention to. So let's try and kick this around a little bit, try and understand what is happening here, how the market is set up, where the risks lie, what regulators and central banks are going to be doing. MRV Associates Managing Principal Mayra Rodriguez-Valladares joining us now, as is our Bloomberg Rome Bureau Chief, Alessandro Speciale. Alessandro, I'm going to start with you here because I think you are in the perfect spot to think about what is happening here. Back in 2008, back in the European financial crisis, the link between government bond yields and banks was a real problem. And I do wonder whether or not we are in Europe potentially about to see that rear its ugly head once again. BTP yields have rocketed higher. Italian banks have got a lot of them, potentially setting up a mark-to-market problem. How big a risk is this?
Well, first of all, you don't want to be the last standing optimist just before the thunderstorm hits. But, I mean, seen from Italy, seen from here, things look considerably more solid. Earlier today on Bloomberg TV, we had Roberto Gualtieri, who is now the mayor of Rome, is the former finance minister, and he was telling me that NPLs, non-performing loans, the real problem of Italian banks during the financial crisis are now much lower, and they are just ticking up, but they are at much lower levels and they are not increasing. The guarantees that the government offered for loans during COVID are also pretty stable, and in fact the 10-year yield on Italian bonds is down today. So what you see now is that the banking sector is supposed to be much more solid. There is also a European system to break this link, the famous doom loop between sovereign bonds and banks. So at least Europe has done some of the homeworks, and now it's a real stress to see.
Yeah.
Possibly it's a real stress to see whether it's not.
Yeah, no kidding. Maida, you've been in this industry for over 25 years, and this is your job, dealing with financial regulation and banks and the regulators and how we're squaring this. Is the doom loop not an option this time? Have we solved the problem?
Well, unfortunately, the issue here is it's a reminder that banks are incredibly opaque. So depositors and investors don't get to see the level of very, very risky assets that banks take on. The problem with SVB was incredible concentration in the types of depositors and investors that it has. It's been relying way too much on unstable sources of funding. SVB, should not be causing any kind of contagion risk. It is a small bank relative to the behemoths like HSBC or Deutsche, Citibank, JP Morgan. But unfortunately, it had poor risk management. It is now practically illiquid. And really, any kind of politician or bank lobbyist who has been advocating for lower capital requirements really should be ashamed of themselves right now.
Okay, let's just pick up on that and continue the conversation. Regulation has forced banks, continues to force banks to hold bonds, risk-free bonds, on their balance sheets in order to compensate for the risk that they take elsewhere. Those bonds have changed price significantly since the Fed started raising rates as aggressively as it has. Are we therefore in danger of having a problem with some of these banks because of that? Also added into that, they're also going to have to be in a position where they're going to have to give their customers a lot more in terms of interest in order to attract deposits going forward from here. Could you walk me through the risks that is going to generate for the banking sector on both sides of the Atlantic?
Yes, absolutely. And indeed, both sides of the Atlantic obviously have been and should be focused on these issues. This comes down to a couple of things. Number one, these bank risk managers have been irresponsible. They have not done the very, very basics of banking, which is called running interest rate sensitivities and doing interest rate stress tests, right? We had been in decades of very, very low interest rates, but every possible regulator, different kinds of supervisors have been warning banks that, of course, at some point, interest rates would be going up. And ever since COVID struck, this has been a main theme that interest rates would go up. So every single bank in Europe, in the United States, all over the world has had plenty of time to be doing interest rate sensitivity analysis. Secondly, you cannot blame regulations. I completely concur with you that, of course, regulations have changed. And so, yes, banks have been required to hold more liquid assets, but that does not mean just holding sovereign bonds. There's a wide range of different bonds that you can hold. And it doesn't excuse you from over-relying on unstable sources of funding and having way too much concentration in assets.
Also, even if you were just in the 2-year, I just pointed out, you had a 50 basis point move in 2 days. That doesn't feel like a safe asset to some extent. Alessandro, we're still looking at a 1.6 trillion euro portfolio of sovereign bonds held within European banks. If I were to look at a crack, where would the crack emerge?
Well, I mean, there are definitely, I mean, this event, it's a real test for the European Central Bank, which has become the banking supervisor for Europe's largest banks since 2014. And banks have been howling because the ECB has been asking it to keep dividends in check, to preserve capital.
Alessandro?
Yes.
Alessandro, hold that thought for 1 second. We have President Biden in the Roosevelt room now talking about the jobs number.
The economy has created over 300,000 new jobs last month. And that's on top of 500,000 jobs we added the month before. All told, we've created more than 12,000 jobs since I took office. Nearly 8,000 of the manufacturing jobs. That means overall, we've created more jobs in 2 years than any administration has created in the first 4 years. And I think all this matters. It's no accident. It means our economic plan is working. And when I took office, the recovery and the economy there was no recovery and the economy was reeling. And 18 million people were unemployed on unemployment insurance compared to less than 2 million today. Unemployment was 6.3%, and nonpartisan Congressional Budget Office predicted it wouldn't get below 4% until 2026. Because of our economic plan, unemployment has been below 4% for 14 straight months since January 2022. Last month, the unemployment rate remained near the lowest level in 50 years. 50 years. And that's really good news. People who are staying out of the job market, this is particularly good news, are now getting back into the job market. They're coming off the sidelines. They're getting back into the job market. The share of working age folks who are in the labor force is higher than it's been any time since 2008. That was one of the big predictors everybody was looking at. Tomorrow, it'll be 2 years since I signed the American Rescue Plan into law. It led to the fastest recovery of any major economy in the world. It laid the foundation for the progress we've been seeing and we see today. Record new business applications, more Americans with health care coverage than ever, including more than 14 million Americans saving $800 a year on their health insurance. Unprecedented tax relief for nearly 40 million families with 65 million children, thanks to the child tax credit, which cut child poverty in half. And since we passed the CHIPS and Science Act and the Bipartisan Infrastructure Law and the Inflation Reduction Act, we've seen companies commit more than $300 billion. Companies from around the world commit more than $300 billion to invest in future manufacturing and innovation here in America, creating jobs. We're going to invest in America again. We're going to make it in America again, and the federal government's going to buy America. That's been my economic vision. But what does this progress really mean for families trying to get by? I'll tell you. It means more people with good jobs and the dignity and security that comes with a paycheck. And while we still have more to do, and there may be setbacks along the way, inflation is now down 30% from what it was this summer. Gas prices are down more than $1.50 since their peak. At the same time, take-home pay for workers has gone up, especially for lower, and this is important in my view, especially for lower and middle income workers. This all adds up to just a little bit, I know you're tired of hearing me say breathing room, but I think that's how people think about it, a little more breathing room for working families. And today's job numbers is clear. Our economy is moving in the right direction. Yesterday I went down to a hall in Philadelphia to lay out my budget and the outlines of my budget, with bills on the progress we made growing an economy from the middle and the bottom up and not the top down. It's a plan that keeps investing in American manufacturing, innovation, and creates more good-paying jobs that don't require a college degree. It protects, strengthens Medicare, Social Security, two bedrock programs Americans have been paying into for every paycheck they've earned since they've been a kid. And we're paying for these investments. We're paying for it all. My plan, after it's all said and done, is going to cut the deficit nearly $3 trillion over the next 10 years, the plan I've submitted. And by making the wealthy and corporations just begin to pay their fair share. You know, when we talked about 28% tax rate, Ronald Reagan was 28% tax rate. You know, that wacko liberal guy, you know. The idea that that's an unreasonable amount, but I'll get into that later. Anyway, it continues to lower costs for families. Building on the work we've already done to lower cost of insulin and other prescription drugs to make health insurance more affordable. It brings down home energy costs, bills for home energy costs. And our plan is a stark contrast to the MAGA Republican plan in Congress, where they're doubling down on the same failed policies of the past that would give special tax breaks to the wealthy, keep the tax breaks that were put in place by the last president, the wealthy tax breaks for big oil, tax breaks for pharma, at the expense of seniors and families. You know, it's kind of a top-down, trickle-down economics that never, ever worked. I know when I grew up, as you've heard me say before, not much trickled-down on my dad's kitchen table. So, you know, my dad used to have an expression. He said, I don't expect the government to solve my problems, but I do expect the government to understand my problems. Not solve them, understand them. Building a budget requires some really hard decisions. But all over America, families are sitting around their kitchen tables making decisions that are equally consequential. That's who my budget is for. It's about a value set, I said yesterday. Working people, middle class, the backbone of the country, small businesses who are responsible for around half of all the jobs in the economy. You know, big corporations, the Fortune 500, they're big. But small businesses account for half the people employed in the economy. My budget reflects what we can do to lift the burden on hardworking Americans. Today's news tells us that thanks to our efforts, 12 million more Americans have jobs. The job is about a lot more than a paycheck, as I said. It's about dignity. It's about your family's dignity. And 12 million more Americans can look their kids in the eye and say, honey, it's going to be okay, and mean it. You know, that's a little more dignity for 12 million Americans. And it's not just good numbers. People can feel it. People are moving back into the work. But this may be the part that pleased me the most about the report, the jobs report, is people who've been staying out of the job market are moving back in, beginning to move back in. Jobs are available. People are working again. They're becoming more optimistic about their future. And now the biggest threat to our recovery is the reckless talk. The reckless talk, my MAGA friends, this is not yours, I heard me say, it's not your father's Republican Party, but the Republicans in the United States Congress, what they want to do with regard to the debt limit. You know, they're threatening to default on our national debt. In fact, planning to default, as some Republicans seem to be doing, puts us very much at risk. I believe we should be building on our progress, not go backwards. So I urge our extreme MAGA Republican friends in the Congress to put their threats aside, join me in continuing the progress we built. We got a lot more to do, so let's finish the job. And by the way, you know, we talk about I just saw my staff handler as I was coming in, the House Freedom Caucus. Members of the House Caucus will consider voting to raise the debt ceiling contingent upon the enactment of legislation. You know what the essence of the enactment of legislation is? Cut all spending other than defense by 25%. 25% across the board. Now that means cops, firefighters, it means health care, that's just what they call discretionary spending, as you all know. And on top of that, what they're really focused on, I saw here, I shouldn't get into all this now, but is what kind of surprised me. They want to make sure we don't have enough IRS agents. You know those IRS agents we had? They're going to check on the accounts of the super wealthy, which require a lot of accounting, a lot of agents to look at it. They want to get rid of them. I don't know. We just have a very different value set. Anyway, I'm optimistic. We're going to get the CPI next week. Hopefully we'll be in some solid shape. But anyway, yes?
Mr. President, are you concerned that rising interest rates will put a damper on this job growth and impact the economy? And you mentioned the Freedom Caucus. Do you have any openness to negotiating on any of the issues that they mentioned?
Well, first of all, we don't know what the CPI is going to be this week, but it's been down. Interest rates have been down. The inflation has been down for many weeks in a row now. And I said, we're going to see blips going up, but I feel confident that we're headed in the right direction. And there's a lot of talk about what the Fed will do and not do. We'll see. We'll see what the Fed will do. But we'll see what the CPI is. I guess it's Tuesday or Monday, Tuesday, Wednesday. Next week is coming out. The idea that I'm going to agree that we start to figure out where we cut 25% across the board. By the way, their entire program does not lower the deficit one single penny. They're keeping, if what they say they mean, they're going to keep the tax cuts from the last president, number one, almost $2 trillion. If they're going to, in fact, no additional taxes on the wealthy, matter of fact, reducing taxes. And in addition to that, on top of that, they're going to say we have to cut 25% of every program across the board. I don't know what there's much to negotiate on. But I'm prepared. I told the speaker, as soon as he's ready to lay out his budget, I'm willing to sit down. And now I'm hearing things like, well, we're not going to have our budget till April or May, maybe even June. All this talk pushing me to get my budget done. I said I'd have it done by the 9th. I had it done by the 9th. I handed it to you guys. I handed it to them. Why all of a sudden can't they get it done in March? or maybe even April, or maybe even May. I mean, I don't know. It doesn't sound like they're on the level yet. So thank you very much.
Thank you, everyone. What are your thoughts on Saudi Arabia and Iran reestablishing diplomatic relations, sir?
You've been listening to President Biden in the Roosevelt Room commenting on jobs and the numbers as well. He was asked a question about Iran and Saudi Arabia. He also talked about that he is confident that the economy is headed in the right direction. He touted the jobs number. He talked a lot about the debt ceiling and his own budget here and the response from the GOP or lack thereof. He's also confident that they're heading in the right direction on inflation, and he wants to stop the reckless talk on the debt limit. That was President Biden speaking on the jobs number at the White House. In addition, we do know that U.S. regulators have now arrived at California offices of SVB Financial Group. That says the lender has struggled to stabilize its finances. There's been a knock-on effect to regional banks. First Republic, for example, the worst performing stock in the S&P, halted yet again, now down just 7%. That's about 2 hours ago. We saw that stock down 51%. So a lot of volatility that's being created here from SVB. And that brings us to the question of the day. Are rate hikes that we're seeing from central banks, ECB, the Fed, creating financial instability? We're seeing it play out a little bit here. We saw it played out in the doom loop in Europe about 10 years ago. Are we going to see it again? Joining us now, Anne Maletti, Allspring Global Investments Head of Active Equity and Chief Diversity Officer, joining us now. What do you think? Question of the day. Are central banks creating this instability?
Well, I do think the rate of the pace of the rate changes has and will create some instability, but But I do also think we do have to look at some of these companies who haven't managed the risk well and put some of the blame on them too. So it's a combination. But one of the things that I just can't help but think about is everybody talks about the strength of this economy. When you start to see cracks like this, I think you have to doubt that the strength is sustainable long term.
So do you think, and therefore central banks should back off at this point? Is this a reason for them to downshift even further? The Fed's talking about going from 25 back to 50 maybe. The ECB seems to be locking in 50 basis point rate hikes here. Should this cause them to reconsider?
I do think that, the Fed is focused on the data, but they're focused on some very specific data. And I'm hoping that they're looking at the collective data set, because we all know that it does take time for these rates to flow into the market. And again, it's the pace of the change that is really causing problems. And so, look, I think we're going to run into more and more conflict as throughout the year due to these higher rates. And again, some companies will manage through it really well, and that's what our investment teams are looking for. Other companies just won't. The failure is going to be a real thing with higher rates and a new capital structure for many companies.
And do you think this is going to happen over in Europe as well, and where would it happen?
Yeah, it's very interesting. Our teams who focus on the global and international markets are looking at valuations across the board. Valuations are attractive in Europe, but again, it's unique opportunities that they're looking for. Regionally, Germany looks more attractive than it did because the fact that valuations have compressed and balance sheets are in much better shape in Germany than in other European regions. And so that's one area that I hear investment teams talk more and more about. Again, they'll also benefit from a recovery in China, probably a little bit more than some other areas. And so balance sheet strength and stability is vitally important.
And one of the reasons why Europe has done so well since the beginning of this year has been a huge rally in the financial sector. Do you think we need to reconsider this on the back of what we're seeing today in the market?
I do think this is something to really pay attention to, and not just domestically here in the U.S., but the second, third derivative effects of what we're seeing here in the U.S. and how that can play out in other regions. Again, our teams are digging deep into this. And, when you see it happen in one bank, you got to look a little bit further than that and figure out where it could happen next.
Well, what's amazing here is just the market overall on an index level. I mean, the S&P is now flat. NASDAQ 100 is now up. I mentioned First Republic here in the U.S. At one point it was down 51%. Now it's just down 7% with lots of volatility. I wonder if we actually close higher today. If it's sort of the buy the dip scenario on dislocations like this is still front and center. Do you agree with that?
It's very interesting that you say that because the markets can be very confusing for investors today. And look, I'm optimistic long term. I would not be chasing in the short term. And it's just because there's so many different dynamics at risk here. And so what our teams are doing is taking advantage of unique opportunities, but there is a lot of money on the sidelines, right? I'm head of equity, but our fixed income teams are very, very happy with the returns you can get, especially short duration right now. And there's less risk there. In the emerging markets, if you think the dollar has peaked, that's an attractive area. Yeah. On the equity side, I think it's more about individual names right now and not taking big bets on buying, an index right now and buying every name.
And we'll leave it there. Thank you very much indeed for joining us today. Busy day, we really appreciate it. Amoletti, Allsprings Global Investments Head of Active Equity and Chief Diversity Officer. Alex, it's going to be really interesting to see and watch across the various asset classes. Clearly, we're getting huge movement in equities, the bond market as well. Credits. Maybe this is a bigger warning in some ways to the credit markets, that actually there could be credit risk here. We're getting great yields at the moment. Maybe there's a reason for that.
Well, and that actually does go to the point of the cash on the sidelines, right? Like, we've all been waiting for credit spreads to blow out. It's a big head scratcher as to why they actually haven't. But I wonder if it becomes more buying opportunity when you do have some kind of blowout, because there is so much money on the sidelines. Or is this when the shadow banking system really gets pinged? Dinged, pinged.
Dinged and pinged.
Ding, 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 pinged. Yeah,
we'll take both. Exactly. Talking of ding, 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 the close is coming up next. That is what we're going to focus on. These are the numbers that we're looking at in Europe right now. Banks certainly getting dinged. This is Bloomberg. So it's been a while since we've seen equity markets lit up like this in Europe. We've been in a relatively tight range for really quite some time. Are we seeing the breakout? Is what is happening in Silicon Valley going to cause that? Well, certainly questions are being raised today. So European equity markets down, let's call it circa 1.5%. The FTSE 100 down a little bit more, but the DAX and the CAC basically down by 1.5% today. So that's the picture we're watching. The story is in banks today. The story is definitely in European banks today. Let me just give you some names. Credit Suisse down by 4.3%. Deutsche down by over 7% coming into the close. Santander's down by 4%. Intesa Sanpaolo. I'm fascinated that Italian banks are some of the best performers in Europe today. The private sector risk in Italy is significantly lower than the sovereign sector risk, but the banks still hold a lot of sovereign risk. Anyway, fascinating story, but this is what is happening in European banks at the moment. So there's certainly some contagion effect, at least within the financial markets, from what is happening in California. Let's take a little look at what is happening in terms of the chart over the last few days, just to give you a kind of idea what is happening. You've got the stock 600 has been moving fairly aggressively. You've had the banking sector obviously on the move this week, and that has been generating a huge amount of volatility. You can see the gap lower first thing this morning. We didn't really get the chance to price that in at the back end of the yesterday session. It was kind of, as the session progressed into the afternoon in the United States, so this SVB story really started to take hold. But first thing this morning, snap, we're down hard, and we've been really tracking sideways ever since then. So that's kind of the picture that we've seen throughout this week. We've been watching obviously very carefully the data. That was the anticipated narrative that we've been paying attention to. What are we going to be talking about next week? You've got not Mr. Macron, but we'll be talking about him in just a moment. But you've certainly got the British Prime Minister heading to California, funnily enough, San Diego, I understand, to talk about the submarine deal, the ARKA submarine